So we're just seeing at the moment, the best way to provide value to your clients isn't to say, who do you bank with? It's to know who the bankers are and who the players are in your market. Make sure that you have that kind of touch point with those lenders as often as possible, because it's changing all the time.
What would be some of the best ways to network with lenders?
A banker will love to take you to coffee or lunch. I used to do that.
You look at anybody who's tangentially involved in a real estate deal, attorneys, insurance, lenders, appraisers, CPAs, they all have the same clients.
What is your interest in becoming an investor yourself, and how can Bo help you do that?
That is a definite plan. As a lender, you get to see the financial statements of these big investors, their real estate schedules, all the properties they own, and their tax returns. And so you get a lot of sensitive, confidential information, but you look at it and you go, how can I be on the other side of the desk?
There's two economies. There's the time and effort economy, and there's the results economy. All of us belong in one or the other. And the question is, which one do you belong in?
Younger in life, I had no intention of getting into commercial real estate. I had no intention of being a banker. Having fallen into it, you look at it and you go, yeah, these guys have worked something out. It allows you to have that freedom. I remember you talking, Bo, about being able to go and take your daughter to a basketball camp for a week. As a family man, that is what attracts me to this industry and wanting to become an investor.
There's a sense of optimism. The phones are ringing a little bit more.
Right.
It looks like going into 2025, there's going to be more transactional velocity. This episode is sponsored in part by the Massimo Group. Are you a commercial real estate broker looking to boost your business? The Massimo Group is the world's premier coaching organization, transforming the careers of brokers just like you, just like it did for me. Visit www.massimo-group.com today to get started and take your career to the next level. This episode is also brought to you by Site to Do Business, commercial real estate's most advanced toolkit, providing commercial real estate professionals like me with premier data, mapping, and marketing tools to win business and revolutionize decision-making. Visit stdb.com to learn more.
Welcome to Commercially Speaking. I'm Timmy Barron, ADHD.
And I'm Bo Barron, CCIM.
And this is the podcast where Bo teaches me everything about commercial real estate investing and commercial real estate really all across the board. But, ultimately, how to get into commercial real estate investing and crush it as a broker, all those things. And yeah, I started as an idiot. Now I'm here. A lot of you looking at this probably like, oh, why is Timmy dressed up like a big, sexy cowboy?
Yeah. Well, we just got back from Massimo Con in Dallas, Texas, and Timmy got himself a hat.
That's right. They gave us all hats. Yeehaw. And so I got that on. But I don't know. I've never been to Texas. I've been to Texas twice now within a month, pretty much.
Yeah.
So I do feel like everything's a little bit bigger.
Yeah.
Well, Bo, what are you teaching me today?
Well, we've got a guest today.
All right.
And I've been excited about this guest for a long time. I actually met this guest right as we were launching the podcast. I taught in Portland, Oregon, and one of the students in that class was a fellow named Isaac Grant, and he's a great student. Got to know him throughout the week. Neat guy. But he is our first accent on the podcast.
Oh.
I'm not going to count Canada, but he's our first international
Sorry,
accent.
Chad Griffiths.
Yeah, sorry. Sorry, Chad. But yeah, man, he's got a cool story. He's got an interesting background, and I'm interested for you to meet him and for us to learn some more about him.
All right, great.
All right? Yeah.
Isaac Grant.
Welcome to the podcast, my friend.
Thank you, gentlemen. It is an absolute honor to join you. Yeah.
Oh, yeah. Excellent. I can hear it now. Yeah,
you got it.
Okay, cool. Let's jump right into it then. Isaac, give us a brief, 5-minute origin story. It could be 5 minutes or less of where you come from and what led you to where you are now.
Firstly, big fan of the podcast.
Thank you.
Bo said, we met in Portland nearly 2 years ago. And yeah, at that time, I was in commercial banking. So I moved to the States 2009. I grew up, I tell folks that I'm from the Deep South when they ask where I'm from. And they look at me sort of puzzled. I say the Deep South of England and then explain how I ended up here. So yeah, I'm born and raised on the south coast of England, met my wife in Oxford in 2007, moved here in 2009. We got married and now we have 4 kids and the rest is history, as they say. Been here for about 15 years. I got into commercial banking in about 2012. So I moved here in 2009. So fantastic time to try and get a job.
Oh, yeah.
Oh, my
yeah.
God.
I remember.
As a young chap, early 20s, just got married, haven't been abroad really ever in my life other than the odd family vacation to France. So it was an interesting time to work out what I wanted to do. I just put together, you could call it a resume, but it didn't have much on it, frankly. I went around town, started trying to work out what I wanted to do, and a credit union hired me as a part-time teller. So I was doing part-time teller at a credit union and part-time cell phone sales for an independent cell phone company that within a couple of months of me joining them had gone bankrupt. Did the consumer side of banking for a couple of years, but my personality type, that was, I learned quite quickly that was not sort of the career path that I wanted to pursue. So there was an opportunity that came open in commercial banking. I did not know what that meant. I honestly didn't really understand the job that I was applying for.
Timmy doesn't understand what that means either.
What was that?
So like you may need to explain that. Let's not assume anything here.
Yeah. So commercial stroke business banking was basically, instead of going in and opening, a checking or savings account as an individual, you were saying, we want to bank your business. And honestly, at a credit union at that time, they were just getting into business and commercial banking. They were not predominant in that space. It was really more the community, regional, national sized banks. If you wanted a car loan and a personal checking account, you'd go to a credit union. If you were a business, you would go to one of the banks. So I applied for this business development officer position, and by a miracle, I guess, because nobody else was really applying for it, I got the job.
Nice.
And within a few months, I realized that the best thing I could do was try and grow their commercial real estate portfolio. I didn't have any commercial real estate background, but I after a few months, we were kind of doing everything we had to at that time because we weren't very big. And so we were trying to get deposit accounts from businesses. We were trying to get, business car loans or their truck loans or their equipment. But they had these fairly sizable goals on the loan side. And you just do some quick math. It was like, well, how many truck loans and equipment loans are we going to have to do to try and hit these goals? Or we could do some of these commercial real estate loans, $1, $2, $3 million at a time, and actually maybe hit their goals. Again, I was just a small fish in a big pond in a lot of rooms, started to try and network, went to a local commercial brokers meeting. I'm not sure if you guys have these in Kentucky, but we had the Red Lion Hotel. It's not a Red Lion Hotel anymore. It's a Natural Grocers. But these guys used to meet in the basement of the old Red Lion Hotel. So I went to one of those meetings, kept going to those for a few months, started learning more. They would pitch deals. They would talk about the state of the economy. There was a couple of other bankers there. So it was just a good room to be in. And then one of the guys that would present and moderate those meetings, I learned, was a CCIM. And he was like, hey, you need to come up to Portland, one of these CCIM meetings. So I think I went to my first CCIM meeting in 2013, 2014, and I felt like a small fish in the ocean at one of those meetings, because guys are getting up and everyone's suit and tie. So he said, you got to be in suit and tie to come to one of these meetings. Yeah. We met in one of the predominant athletic clubs in downtown Portland, and I had no idea what most people were talking about in the room, but I loved it because things were happening. It was high energy. I think the maximum loan size we could do at a credit union at that site, for the specific credit union I was working at, the maximum loan size we could do was about $3 million. And guys are getting up there. It's like, yeah, we got a 1031 exchange client coming out with $15 million in net proceeds looking to place. And I'm just sat there like, whoa. I don't know what a 1031 exchange means, but whoever that guy is has more money than I can lend. So he doesn't need me whatsoever. But I want to come back and learn more about this. Over the next sort of decade, I guess, kept going to those meetings. We became a power partner sponsor. I guess all the CCIM chapters across the country have affiliates, businesses that will sponsor the chapter to help out. You get a little more exposure. So yeah, that's kind of how I got into the world of commercial real estate. And then a couple years ago, I realized that you could get your CCIM designation as a lender. You didn't have to be a broker, but you could be a lender and take the classes. So I first signed up for a class in 2020, but it got canceled due to COVID. Yep. So it took me a couple of years to actually get through the 101 class. So I took 101 in May of 2022, and then decided in 2023 I can finish the rest of them and take the test. That's how I met Bo.
That's right.
And that was an awesome class. I really enjoyed Bo and Michael Hieronymus taught that class.
Oh,
Yeah. That
oh,
was
heavy hitters.
Me and Hieronymus.
Wow.
That was a lot of fun.
Fantastic teaching duo.
So go ahead. Yeah, go ahead.
No, I was going to say, so I sat the CCIM exam October of last year. I was still working for a bank at that time. Obviously put it out on LinkedIn, as everyone does when they get their CCIM designation, let the world know that you've just passed that test. And a couple of brokers that I know in our local market, great guys that I've done deals with before, very similar values to mine, reached out and said, hey, do you want to come chat about business? It was literally about a year ago this month, November of last year. They said, hey, if you ever thought about coming over to the brokerage side, we'd love to talk to you about that.
Oh.
And at the time, most of your listeners will probably remember this, rates had gone up fairly significantly. The market had changed somewhat. And so as a, banker, I was somewhat data-driven or data-driven, to be culturally sensitive. So I started looking at I just started looking at the data of, okay, well, how many deals have actually closed in the last 18 months since we had these interest rate hikes? Because if I'm going to make this switch, I want to make sure that it's actually somewhat viable coming in at this point in the market. And so I was somewhat hesitant, to be honest, about making that switch. My wife and I, January of this year, 2024, we said, okay, we're going to take January and pray about this. And I know that's something that you've talked about on the podcast before. I love the episode with your dad, and I just listened to the episode that you did with, was it Matt and Justin Ryder?
Yes.
How they came from a young, they came from a Young Life background, and that's really good. I mean, that's how my wife and I met, was through a church in Oxford in England. So so we took January. We were like, okay, let's pray and let's see about this. We got to the end of January, and my wife Rachel said to me, "So do you think you've got any clarity on this? You think you want to make a switch?" And I was like, "Yeah, not really." I said, "I got enough clarity to maybe start the, real estate classes on the side, because to get your real estate license, you have to go through like 150 hours. So maybe I'll start doing that on evenings and weekends and see what happens throughout the year." I was sat in this very chair at home on February 1st. February 1st, about 8:30 in the morning, I get a text message from amazing CCIM. I got to give her a shout out. Her name's Renee Nelson.
Oh, I know Renee.
One of the best brokers. Yeah.
She's fantastic.
Yeah.
I know her through the Massimo
Renee.
group from years ago. Yeah.
You should definitely have Renee on the podcast.
You're right about that.
Is
great.
She is one of the greatest people and one of the greatest brokers and CCIMs out there. So she texted me and said, "Hey, do you have a couple minutes for a phone call?" I said, "Yeah, sure." She said, "Hey, I've got a situation, got some family with some health things going on, but I've got some guys looking to buy some apartment complexes. And if you're thinking about, making that switch over to brokerage, would love to have you work with me on this."
Nice.
So, it was one of those moments where it's like dumb little Isaac here the day before told his wife, I don't really have very much clarity on this. I'm not sure if this is something I should do. And then the very next day it was like, okay, that's a pretty decent answer. It's still going to be difficult. It's still going to be a lot of work. It's, you're going from a nice W-2 job and a career that you've built over a decade, and we have 4 kids and plenty of stuff going on in life, to switching to be entrepreneurial and what have you. But it was fantastic. So I'd actually spoken, I think in that January, I said, I'm going to speak to 3 people. And one of them was Bo. And Bo gave me a fantastic piece of advice.
Ooh,
any
nice.
listeners out there who are currently, any listeners out there who are currently in a W-2 job and you think about becoming an entrepreneur, Bo asked me a question that I really thought about for a few days. He said, do you want to be in the time and effort economy, or do you want to be in the sort of more performance-based things are on you economy, where you just have to go out and make things happen? Which one of those two? There's not a right or wrong. I think I was looking for someone to tell me what's the right decision to make, what's the wrong decision to make, which path should I take here? And Bo just laid it out for me really well.
Well, let me give credit where credit's due. Our dad, who you met on the podcast episode, he was involved in an entrepreneurial coaching program called Strategic Coach when we were growing up. And I used to not steal, but I would go find those materials, and like they had like audio cassette tapes back then and stuff like that. And I would listen to them. And I remember, I think I was probably in college, and I grabbed one of those tapes and I was listening to it. And the founder of Strategic Coach, Dan Sullivan, he laid it out that way. He was like, there's two economies. There's the time and effort economy, and there's the results economy, the performance-based economy, you know. And here are the pros and cons of one, and here are the pros and cons of the other. And the point he made, which is really what you're talking about, and what has always stuck with me, is it's not a moral decision. It's not a good and bad. They're just different, and they're both very real, and all of us belong in one or the other. And the question is, which one do you belong in? And so like as my kids have grown up, and they're 22, 18, and 15, we talk a little bit in those terms. And one of the things I'm trying to help understand for them and help them understand is which of those economies do they want to be in? Because it makes a huge difference. But if you have that amount of clarity, then you can go, because look, the educational system spits out W-2 people.
Yeah.
Time and effort. I mean, like, go get a degree, go get a job.
Right.
And like the whole educational system spitting out W-2s. Well, that's probably a good thing for a lot of them and a terrible thing for a lot of their students.
Right.
You know, and
so good.
So, yeah. Well, that's cool that you remember that.
Yeah. That's great clarity. Before we do move forward on the timeline, so I used to coach actors, and I would talk to a lot of actors that were overseas or outside of America. And it's just so common of like, how can I get to America to start working and acting? Right. And so for any of our listeners that are not in the United States, but living elsewhere, and we don't have to spend too much time on it, but how did you all get over here? Like, what was the avenue that got you in here and able to work?
No, that's a good question. I'm interested in.
Right. Yeah. Because like Tara's over here because we got married, you know, she came over and she had a visa for a certain amount of time. Then we got married. So with you both being from England, what's up? What's up with that?
So my wife's from Oregon. So exact same scenario. So my wife is from Oregon. She was in Oxford, England for 1 year back in 2007 when we did an intern program at a church there. And it got towards the end of that year, and I was like, and I really like this girl. I'm going to have to make a move here. I came and visited Oregon in 2008, towards the end of 2008. We got engaged that year, but we were doing the long distance thing because, as you may have found as well, Timmy, I don't know what it was like for you and your wife, but it was a process. Like, we hired an attorney. My brother-in-laws joked, you might cut this out of the podcast, I don't know, but they joked that I should just fly to Mexico and drive on up.
No, we'll keep that in.
It's hard to do things in a legal way sometimes.
Yeah.
You know?
We went through the proper avenues. Yeah. So that took a serious amount of time. So so we did the long distancing for a year. Skype had just become a thing. That's not a thing anymore.
Right.
All these young folks on FaceTime and what have you, but Skype, I'd like to shake the hand of whoever invented Skype, because that was fantastic. I'd wake up at like 5 a.m. Rachel would stay up till 10, 11 with the time difference, so we could actually talk every day.
Right.
So that's how I ended up in the States.
I see. She's American, which I didn't get that.
Here.
Okay.
Yeah.
Okay. So, I mean, that was always my advice too. Just find an American you can marry.
Yeah, when you do it the right way, they really do check in on you those first few years. Like, we had to, I remember it was after like 2 years or something. I don't know. We had to like send in photographs of us together and power bills with both our names on and kids' birth
certificates. Did you have to do that too?
And stuff to prove that it wasn't just.
I did.
We had to prove that it was a legitimate marriage. I think we got a slight delay. My bad.
No, that's okay. That's okay. We do, but that's not a problem at all. I did. And again, not to spend too much time on this, but she came over and she had, of course, she was working out of the States, with the cruise ships. So she had that visa, and we were apart for about a month. And then she came over and she was able to stay for, I think, 6 months before having to leave the country and come back in. And at that point, we'd already talked about marriage, but it was so funny going to that lawyer and all the questions they were asking about, like, How many fights do you get into? You know, like trying to see if we were a legit couple. And at that point, it was still like honeymoon phase. And we're like, we never fight.
How about now?
Yeah, it's different now. It's different now.
I remember, so we got married. So we had to get married within 90 days, I think was the rule of me entering the United States. So we had to time it right to invite people to the wedding based on when I got my visa approved. So that was an interesting process. But I remember after we got married, we had to go to I think it was the immigration office or something. And yeah, one of the questions they asked was like how our parents felt about it.
Yeah.
You want to call them or something? I think they're both pretty happy about it, to be honest. Yeah.
Yeah, that's it. Well, anyway, for all the listeners, there's an interesting peek in what that looks like on that way. All right.
Yeah,
so
anyone doing long distance right now, Timmy and I can help you out.
Yeah.
Yes, we can. Yes, we can. Please, yeah, hit us up. Hit us up. So, okay, so now you've got your CCIM. You've got this call from, what was her name?
Renee Nelson.
Renee. And so I'm assuming that was the first deal that you did on the brokerage side. How's it going?
It was a really fantastic process. And I was listening to one of your guys' episodes you just did. Was the guy that was doing the marketing, was his name Wes?
Wes Gay.
Yes.
So I listened to that episode and he put it really well, where as the broker, you're not supposed to be the hero. And I really felt like through this process, the buyers, so we represented the buyers, amazing brothers who were doing the purchases on behalf of their family. They wanted to be in apartments. They were just really level-headed, fantastic guys to work with, which made the whole process. For my first deal, it couldn't have gone any better at all. But yeah, I was up late researching properties for them. We're trying to see what's on market. Are there any off-market opportunities? Spending Saturday mornings, Renee and I would get on a video call, not too dissimilar to this, and go through numbers and go through what's called T12. Have you looked at T12s yet, Timmy?
No, I don't think so.
On any of the episodes?
No. This is the one.
So a T12, you know what a P&L is, though?
I don't know if I do. Do I know a P&L, Bo?
Profit and loss statement? Oh. You may not.
No, I don't think so. No. Well, this is a good episode. Isaac.
Yeah. So a P&L, the profit and loss statement, is for the property specifically. It's also known as an income statement. Some folks call it an income statement. But it'll say, okay, how much income has that property generated from the gross rents minus the expenses? You come to the net operating income, which I know you have talked about because I'm sure I've listened to an episode where you guys have spoken about that.
Now, look, I want you to keep explaining this to Timmy, okay? But I'm going to get up and I'm going to walk over to my desk because I just printed out a T12 and a P&L along with a rent roll on a piece of property that we're doing a proposal on. So I'm going to show him what you're talking about. So you keep explaining and I'll be right back.
Fantastic. So that was kind of my initial baptism, I guess, into the brokerage world, was working out with these properties. They've been marketed. You get given these P&L, profit and loss, income statements. Where the T12 acronym comes in is typically a profit and loss statement is going to be like a January through December. So January through December, here's a snapshot of the net income that property has made. A T12 is an abbreviation for trailing 12 months. So it's a profit and loss statement, but it might be, September through August. So it kind of splits over a year. So if we're looking at buying a property and we start analyzing it in May, we're looking at the previous 12 months through May of that year. So that we call that a T12. So the first couple of deals, that was a lot of what we were doing was taking a look at those, working out is what has been advertised in the offering memorandums. So that's like the package of information that gets put together from a listing broker who's representing the seller. They put that information out there and then we're representing the buyers. So we want to make sure that information is legitimate. We agree with the net operating income numbers that they've presented in that package. So it was a fantastic experience. Now, I knew how to do that because I was a lender.
Well, stop right there for just a second. I know I'm being very directive and bossy right here, but I think this is valuable information. One is I asked for a T12 and they sent me the year to date. Okay. So the T12 is the trailing 12. I wanted the last 12 months, like a year, but like we're in November. So give me like October 2023 to October 2024. I want 12 full months. They sent me year to date. Now we're in November as we record this. And so if you look on this P&L, by the way, P&L is P and L, profit and loss statement. They call theirs a cash flow statement. Same thing. Okay. All right, basically. And what Isaac was just describing is because he represents the buyer, he needs to dissect these numbers. Well, let's talk about a couple examples on this sheet right here, which you can't see, Isaac. And we're not going to talk about specifically what property this is, but there's some mistakes in the numbers that you normally see on a P&L statement that you have to translate as a broker to what the NOI actually is. And so, Isaac, just off the top of your head, what are a couple examples of things that you'll generally see in a P&L statement that you have to take out to get to the NOI?
Yeah, so some folks will still leave in what we would call expenses that are below the NOI line. So they're specific to that individual property owner, and it's going to look different for my buyer once they own the property. So like interest expense on the mortgage. So they've had to use debt to buy the property. Interest expense is not an expense that we count in the net operating income because that's going to be a different number when my buyer buys it, especially like in our situation, the folks that Renee and I represented were all cash. So they didn't need debt to buy the property. And I'll talk a little bit in a moment about why they decided to go all cash and not take on any debt.
Well, that's a great example. So a lot of times you'll see interest expense in here. You have to add that back in to figure out the NOI because what they're calling net income on this, which is their revenue minus their expenses. Some of those expenses are not operating expenses tied to the building. They're expenses tied to the owner.
Right, which would be changed.
Now, there's some other differences here that you have to add back in. For instance, if you look at their, like the roofing expense.
Yeah.
Like you see a couple of those months, there's some pretty big numbers. And so to a lender or to a broker who's done this more than once or twice, they're going to see that. And I got to ask a question about that. Because if that's a roof repair, it probably won't be that high. And if it's a repair, you expense it. If you replace a roof, you have to capitalize it, which means it won't go in the operating expenses because that's not something that normally happens.
Right.
You don't have to replace a roof on a regular basis.
Right.
That's a big expense. So you capitalize it, you end up amortizing it, but you take it out of the expenses. So I've got to add that I've got to add those numbers back in because I confirmed that those 2 roofs in that portfolio were replaced. I got to add that back in. That shouldn't come out of the NOI. Now, a owner or a seller will want to make an expense out of it so they can deduct it from their income and pay less taxes.
Sure.
That is not correct.
Right.
And so that's kind of another example. And so a lot of times when you're underwriting a property, you have to get used to staring at these numbers and thinking, no, that's not right. That shouldn't go there because pretty much everybody does their cash flow statements or their P&L statements however they want. And they hope the IRS doesn't slap their hand for it later, including certain family members of ours.
I see.
Who used to think, expense everything.
Right.
Pay less taxes.
Yeah. I see.
Let's hope we don't get audited.
Yeah. And so, Isaac, what you were saying was you're going through what Bo just kind of explained to me, the T12, and your experience as a lender helped you through this process.
Absolutely, Mike. So as a lender, we're trying to work out, is the net operating income that's been presented legitimate as well? Because and this is one of the major differences that I've learned, and I actually learned it going through the CCIM classes. It was one of the most eye-opening things in sort of 101, 104 especially. As a lender, we were always looking backwards. What has this property made in net operating income over the last 5 years to see, do we think it can support the level of debt that is being applied for on a go-forward basis? And so we would project forward a little bit, but we're really looking back as the indicator. So we'd want 3 years of tax returns specifically for the property so that we can work out what that net operating income is. When you're a broker representing a buyer or you're the investor, if you're actually the buyer yourself, you're the investor or you're a syndicator, you're looking ahead. You're looking at if I buy this property today, what can this make me going forward? And so that's a really important delineation as to how different people in the process to get a transaction over the finish line are looking at it from different angles.
And we've talked about that a little bit.
My background as a lender to...
Sorry, this delay, I'm cutting you off all the time. But we have talked about this a little bit in the sense that, you know, every time somebody buys something, they're the one that ends up paying the most for it.
Right.
And it's not as like people get so fixated on not overpaying for something, which is a data point in the process.
Right.
But it's not the main thing. The main thing is, what can I do with it once I own it? And so I had the same eye-opening experience when I went through those courses like Isaac was describing. It was like, this is how you project out what I can do with it. And then based on looking forward, what's my return going to be? And what you pay for, it's just one data point there. What you borrow to buy it is just another data point. It's factored in. You project forward with all those cash flows that you think you can pull off, and then you can calculate what your internal rate of return is over the course of a 5 or a 7 or a 10-year hold kind of thing.
Yeah.
And then you're right. And a lot of times I have to help lenders see how I'm evaluating a property.
Right.
Yep.
So with the first property, so we helped these guys this year buy 2 apartment complexes, and they did pay all cash for them. They'd sold a family business, and so we're paying all cash. We actually just closed the second one at the start of November.
Woo-woo.
So it's
Congratulations.
a long process, you know, from when they started. Yeah. So it's a long process. One of the, two things. One, what we're talking about right here, mistakes from what's included in a P&L or an income statement in a listing package compared to what's reality. So these were brand new apartment complexes that these guys purchased. And so the first one, you don't have a historical P&L. It's just leased up. They've just got all the tenants in. So we've really got like a T3 or a T4. You know, you got 3 or 4 months maybe of actual. So we're having to guess what's the go forward going to be. And in the listing package, one of the income line items they'd included was parking. So they were going to charge all the tenants for parking spots. When we got the actual information, once we were under contract, there was maybe 2 folks that were paying $50 a month each for parking, if my memory serves me correctly. It just wasn't there. So we're talking thousands of dollars that were in the presentation for the listing that in reality wasn't there. So that caused us to just pause for a second, and we had to kind of work with who was going to be the property manager, who's actually going to be operating this property for our buyers after it closes, to say, okay, well, we need to come up with what we can all feel is a comfortable NOI that we are confident in to move forward at this price. So we actually negotiated a slight price reduction from where we were at from the contracted price due to that fact. So it's really important to go through those numbers and make sure that, you know, what we saw originally is what's actually happened in reality.
Right. And so with your experience as a lender, what is something through, especially what you've learned over the last several months, what is something that you would want all brokers to know that maybe they don't know from the lending perspective?
Ooh, that's a good question.
That's a great question in the current climate. So if you'd asked me that question 3-4 years ago, so 2020 and 2021, will know this better than most on the broker's side. The amount of deals being done was like something we haven't seen before. And so as a lender at that time, what would I want brokers to know?
Your phone
We're
number.
at the mercy of these appraisers. Yeah, exactly. Yeah. I want brokers to have me on speed dial at that time. Absolutely. But the main thing we needed at that time as lenders was a little bit of time. You know, they'd be throwing 45-day closes into these contracts, and we'd say it's going to take us 2 months to get an appraisal because all the appraisers were so busy with how much was happening in the marketplace. We couldn't get the reports quick enough to be able to underwrite and close the properties. Now, the thing that brokers need to understand the most, and a lot of your listeners are going to know this through what they're experiencing in the market, interest rates have gone up significantly. So that time when it was, I heard a guy the other day say back then, if you could fog a mirror, you could get a loan. That was his interpretation. That was his interpretation of 2021 commercial real estate market. Interest rates then were maybe, 3.5% to 4.5%. fixed for 5 or 10 years in some cases. They're now around 7%, give or take, 6.5 to 7.5, depending on which bank. But there's fewer loans being originated because of the balance sheet issues that banks are having. So what I mean by that is because the banks lent out money at 3%, in a normal market, folks are always buying and selling. You know, this guy's going to sell, he sees an opportunity, so he's going to sell this property, 1031 into something. And so for the banks, that means they're always getting loans paid off. Every month, something's probably getting paid off. So this bank's getting paid off and this bank's doing that loan. And there's just this kind of natural movement of money within the marketplace. But right now, that has stopped because nobody's selling. Because why would you sell a 3% loan, have to 1031 so that you don't pay the tax, and go buy something at 7%, you're at a loss immediately. And so the banks have stagnated, like we just came to a halt, basically. So that's on the loan side. So the banks are not getting paid off at the normal rate that they were previously. On top of that, because of where treasury rates are, your biggest depositors at the banks took their money out of the bank, especially when Silicon Valley went down and First Republic. Your biggest depositors said, why should I leave my money in the institution, even if you're paying, you know, a money market rate of 4%, let's say, when I can just go into a government-backed security at 5%, why would I leave my money in the bank? So not only are the banks holding more loans on their balance sheet, they've actually lost deposits. So the biggest thing brokers need to understand is, are you kidding me? Banks would love to lend at 6-7% right now. There's just not enough liquidity in the marketplace for some of these loans to get done. So it's just understanding that, and this is what I've told folks recently, you really need to know more than just one or two bankers in your marketplace, because different banks have different appetites for deals at the moment. It used to be that if you told a banker, well, you know, we're shopping with this other bank as well, they would maybe sharpen the pencil, be like, man, we don't want to lose this deal. This is a great client. Now folks are going to the bank saying, well, you know, we're having these other guys underwrite it too. And the bankers probably aren't going to tell you this directly, but they might be thinking in the back of them, like, that's fantastic. Please, yes, go get that loan somewhere else, because our balance sheet is such that we need payoffs, not new loans.
So we have banks in this market right now that have a lot of commercial real estate on their balance sheet. All right. It's listed as an asset on their balance sheet. There is loans owed against it. All right. And guys like me who own property are making our loan payments. And I've got some of those 3.5%, 4.5% mortgages. I've got a couple of them. And so I'm paying on those. What they would love for me to do is pay that thing off somehow so they can turn around and recast that at 7%. So instead of them making 3.5%, now they're making 7%. But I don't really want to sell that thing because, man, that's a great rate. That's almost like free money.
Right. You know? Right.
And if I went and took my proceeds and turned around and bought something else, whether it's 1031 or I'm banking on getting bonus depreciation back with cost segregation or however I'm going to make that work, I'm still probably going to have to go get another loan at a much higher rate. And so right off the bat, like he said, I've lost.
Right.
That spread is
right.
worse and in the bank's favor.
I understand now, yeah, the predicament.
We've got other banks in this market that weren't very commercial real estate heavy on their balance sheet. And they are more liquid. And they're the ones that are more active in the space right now.
Oh, wow, yeah.
And so I used to do more business with this bank over here, but because of some of the loans that I have on their balance sheet and many others, they just can't, they're not in the game as aggressively anymore. They're just not doing much because they don't have the money.
Right.
They're not liquid. They've got assets on their balance sheet, but they're not liquid.
Yeah.
They don't have the cash to just turn around and make another loan. But this bank over here, they're in the game.
Yeah.
Taking advantage of that. And because they were maybe just more conservative through 2021, 22, they're doing much better today. And this other bank over here, which was basically my best friend before, like they're really struggling.
Right.
Really, because the rest of their peer group are making loans at 7% and they're stuck making their 3.5% and 4.5%.
Right.
So not only can they not do anything, but they're falling further and further behind.
Right.
And it's a big mess.
Yeah.
And
So what does that look for, like, what's the forecast now? Because we got a new administration in, right? So what
Well, not yet, but it's coming.
I mean,
right?
yes,
Yeah,
we got a
just
new
had
administration that will be coming in. So I'm curious to hear from you as well as Isaac. Like, what's the forecast now? Like say the interest rates do go back down, or does that help those banks? They're struggling right now.
Well,
because
hold on just a second.
Yeah.
Listen to this. And Isaac, I'll be interested to hear if you agree with this. Interest rates have just gone down. All right, we've had 2 rate cuts in the last couple of months. So we had a 0.5% a couple months ago, and just last week when I was in Seattle, they cut interest rates another 0.25%. Okay, that's the federal fund rate. So the Federal Reserve. Now that doesn't directly impact what I can go borrow money on a commercial deal. What those interest rates are tied to the Treasury rate, the 10-year Treasury, pretty much.
Yeah.
And so what Isaac was just describing was the dynamic where since they've cut interest rates, treasuries have not gone down. They have gone up. You want to know why? Because of the dynamic that he was, and this is where I'm wondering if you agree with this, Isaac, but big depositors took their money out of the bank. And where do they put it? They put it in treasuries, which created demand for government-backed treasuries. And when there's more demand for something, what does that do to pricing?
It goes up.
It goes up. And so you had many, many more dollars going into these treasury markets, bond markets, or whatever you call them. And it's driven the rate up, even though the Fed is cutting rates. And so the commercial loans, I haven't seen them go down yet. So there's an optimism in the market because of the federal fund rate cuts. And that's good. We're starting to see like money that was on the sidelines re-engaged. Like there's a sense of optimism. The phones are ringing a little bit more. Right. It looks like going into 2025, there's going to be more transactional velocity. There's going to be more deals, but we haven't really seen the rates affected at all yet. But the interest rate environment hasn't improved yet. But I do expect that it will.
Isaac.
Would you agree, Isaac? As a commercial real estate broker, your success depends on the right strategies and guidance. The Massimo Group, the world's top coaching organization for brokers, can help you scale your business and increase your income. And as a former client, I've personally experienced how their coaching can transform not only your career, but also your life. Don't wait to grow. Head to www.massimo-group.com today and see how their proven systems can work for you. This episode is also brought to you by Site to Do Business, the ultimate commercial real estate data analysis and mapping tool. Whether you're a seasoned professional or just starting out, Site to Do Business provides the data and insights you need to make informed decisions and close deals faster. Frankly, it's the tool that I use the most in my business. Access comprehensive market analysis, demographic data, and powerful mapping tools like ArcGIS, Placer AI, and Flood Maps all in one place. Identify the best locations for your clients, analyze market trends, and present your findings with confidence. Don't miss out on this game-changing platform. Visit stdb.com today and see how it can optimize your business. And now back to the show. Would you agree, Isaac?
Yeah, I think what we were just describing about the bank's balance sheets, I think there's a lot of optimism now with the new administration coming in, just in markets in general, not just commercial real estate, but just markets in general. But I think there's some fundamentals that are still going to take some time to work out. The banks overnight are not going to suddenly be able to shift all this 3-4% debt because the fundamentals of what can I go buy and at what interest rate are still there in the marketplace. So I think it's going to take a little while, but I think it is going to be interesting the next couple of years because the time period we were talking about was 2020 and 2021. And a lot of those loans, the interest rate is only fixed for 5 years.
Right.
Maybe 7, maybe 10.
So those are
but
starting
a lot
to come
of them in the
now.
commercial world are fixed for 5 years. Yeah. So those rates are going to reset. Live scenario. Just this week, I've been talking with a potential buyer client. He's looking for retail property. He wants to buy at a 7% cap rate because interest rates are probably in the mid 6s. So he's looking for a product, tough to find, but we found a couple of opportunities. So we found a couple of opportunities for what I would describe as probably Class B retail centers, 21 unit, price range probably 6 to 7 million. And so the value for brokers, value you can provide your clients as a broker is to know all of the lenders in your market and know them well, which for me, I have a little bit of a competitive advantage there because as a lender, you know, you're networking with other lenders at a lot of these events, you know who your competition is.
Yeah.
So earlier this week, so he asked me, hey, he said, I got 50% cash down. For a lender, music to your ears, right? So you're reducing our risk immediately. You have 50% cash down. A few years ago, you would have had every bank in town want to do that deal. You got a 97% occupied retail center in a fantastic location. It's got 50% cash down. I contacted 7-8 different lenders, sent out to all the folks I thought might be interested. I got I don't even know how to put it in the words, the responses I got. I got one response that was basically, well, we could do it at 7.5% fixed for 5 years, but the buyer would have to pay for our attorney fees to get the deal done, which some banks do. When you get into really, really big deals, some bigger banks will do that if it's going to involve more loan documentation, what's called SNDAs, which we can get onto in a little bit. I just realized I'm throwing things out.
It's all right. It's all right.
So that was interesting. So that's one end of the spectrum where I was like, wow. So you're basically telling me you don't want to do a loan.
Yeah.
Other end of the spectrum, we had a regional credit union who gave us a fantastic 3 different quotes with different rate ranges from 6.1% to 6.75, depending on how long they wanted that rate fixed for, how much they'd be willing to pay for a loan origination fee, what sort of structure the prepayment penalty would look like. So we're just seeing at the moment, the best way to provide value to your clients isn't to say, who do you bank with? It's to know who the bankers are and who the players are in your market. And at the moment, you honestly need to make sure that you have that kind of touch point with those lenders as often as possible, because it's changing all the time. Next month, I could contact all of the same bankers with the same scenario and get a different response depending on what's happened in the last month for their institution.
That's such great advice.
Yeah.
And not just in this environment. Like, that is great advice.
Period.
All the time.
Yeah.
Now, in these other, like he was describing, highway brokerage, stand on the road and get run over by a deal, fog a mirror, you can get a loan. Even in those environments, to understand which banks prefer which property types, and that's great information to have. And I've spent a good part of my career trying to develop relationships with the commercial lenders at the major banks in our market so that I've got options so that we can help each other. I'm working with somebody over here and they want to buy this property type. And I know already, because of these relationships, like, these 2 banks are really going to favor that deal. Like, this is right up their alley. But if he wanted to do industrial instead, we'd be talking to these banks over here because they prefer those type of deals. Like, to know that as a broker gives you the ability to provide a tremendous amount of value to your clients. And that's a big deal.
Yeah. Well, my question then is I'm very curious to hear what Isaac says because of your experience as a lender. What would be some of the best ways to network with lenders or to build those relationships? Yeah. Is it simple enough to give a call or have some meetings? Are there other things I'm not thinking about? Like, what's the best way to network with lenders, in your opinion?
Most lenders are going to be at commercial brokerage networking events. One of the biggest ones being CCIM, but not every market is going to have a CCIM meeting for you to attend, but they might have some level of commercial brokerage networking, either a breakfast, a lunch, a 1-hour pitch meeting. That's one way to get in contact with a lot of lenders at the same time, because they like showing up to those they're trying to get clients for themselves as well. I think one of the other ways is honestly just to look up online commercial bankers and then just start reaching out to a banker. Will love to take you to coffee or lunch and hear about who you work with, what you're working on. I used to do that. I would know who the players are, who are the brokers, because the brokers have the relationship with the client that the banker is trying to have as a client as well.
Yeah.
And so there's sort of a lot of mutual synergy and networking that can happen.
And the opposite is true as well. Like, the lender has a lot of the relationships with buyers and sellers that the brokers want. And so there's a huge overlap. Like, my clients as a commercial real estate broker are the exact people that commercial lenders want to have access to.
Yeah.
And the opposite's true. And so when I was trying to develop relationships with commercial lenders, I would just say, hey man, let's grab lunch.
Yeah.
Let's talk about your business and mine and how we can help each other. I mean, never once got turned down.
Yeah.
You know?
Yeah.
And as long as you're eating with somebody that like, man, I like this person. I feel like I can trust this person. They've got a good reputation in the market. Then you just continue to develop that relationship.
I think that's great information to know, especially for people at the beginning of their journey, to know that, oh, it's as simple as enough, not just to go to these networking events, but to give them a call and set up a lunch or whatever.
Not only that, but think about who else is in the same boat as brokers and lenders. Appraisers are often in the same boat. They mostly work for lenders, but not always. All right. And they're great to have relationships with, because in the same way that brokers and lenders have relationships and clients that overlap, brokers and appraisers have information that each other need. And so having a great relationship there can really help you access information back and forth. CPAs are just like that. Their clients are our clients. They want access to our clients. We want access to their clients. And so having those kind of relationships that you strategically try to go out there and build over time, that's great for somebody or anybody, however long they've been in commercial real estate. Insurance agents, same thing. The people who, and you look at anybody who's tangentially involved in a real estate deal, attorneys, insurance, lenders, appraisers, CPAs, all of those people touch just about every commercial real estate transaction, financial advisors, but they all have the same clients. And so to have great relationships with those connectors are huge to a career.
Yeah.
Yep.
Nice.
Yep. That's a really good question, Timmy.
Yeah. Well, thank you. Thank you. Thank you. Well, I guess, but the question I have now is a personal question for Isaac. Isaac, you've been a lender. You're now experiencing being a broker. You've seen all these deals get put together from different angles. What is your plan or interest in becoming an investor yourself? And how can Bo help you do that?
Yeah, that is a definite plan. That is a definite plan. I think I need a couple more years. I got to make sure this brokerage thing is sustainable. I'm indebted to Renee Nelson and Matt Hogan, Gary Martin, the guys that are my principal brokers, for giving me the opportunity. So I got to make it work. And then once I've made it work, I definitely want to become an investor, because especially in that period of time, you know, sort of 2017 to 2021, as a lender, you get to see the financial statements of these big investors.
Right.
And you get to see their real estate schedules, all the properties they own, and their tax returns. And so you get a lot of really sensitive, confidential information, but you look at it and you go, how can I be on the other side of the desk?
Right.
That's what I did anyway. A lot of lenders maybe don't think like that or feel like that, but I would look at it and be like, these guys have worked something out. And really, I mean, younger in life, I had no intention of getting into commercial real estate. I had no intention of being a banker or I did not know what any of that stuff meant as a young pup that had just got married. I kind of fell into it, but having fallen into it, you look at it and you go, yeah, these guys have worked something out, which is really fun and really cool. And I know Bo has talked about this as well. Once you've reached a certain level within the industry, it allows you to have that freedom. I remember you talking, Bo, about just being able to go and take your daughter to a basketball camp for a week or what have you. Those sorts of things. I think as a family man, that is what attracts me to this industry and wanting to become an investor eventually.
Yeah. Yeah.
But there's no such thing as passive investment. Yeah.
That's very true.
Right.
Well,
Elaborate.
Well, look, you'll hear all kinds of people talk about passive investing. So think about the high net worth doctor or the attorney or whatever who decides to take part of their wealth and they're going to invest it with somebody else in commercial real estate. Okay. Those guys are kind of passive investors.
Like as an LP, right? Coming in as an LP.
Could be an LP or a private money partner kind of thing. I think what Isaac, I don't want to put words in your mouth, but I think what he's saying is when you're in the industry, like how do you passively invest in commercial real estate when you're a commercial real estate professional?
Right, right.
Like it's your thing.
Right, right.
You know, so it's not as passive as, and I've seen some people like get up into the back ends of their careers and say, okay, I'm just doing the LP thing now. I'm going to invest with other people. I'm going to turn my brain off. I'm going to let them do their thing. I would say that's very difficult to do.
Mm-hmm.
And even in this Hearthstone Capital thing where we're a fund of funds and we're basically on the LP side, we're still paying a tremendous amount of attention to the deals that we've invested in.
Sure.
Like it's not passive. Like we are paying attention. We are reporting to our investors. We are, like there's work there. I think that's what he meant, but he can speak for himself.
Yeah, I should rephrase. I can't be a passive investor.
Yeah. Right.
Yeah.
Right. And I've learned too, like just recently, because there's a program called CRE Investor Coach with our friend Brad Arns. Shout out to Brad Arns. He hired me to do some editing of his videos. And so I'm just learning through that the humongous benefit of the proper structure of a deal and the benefit of being a GP on that. That general partner, and the amount of money that you no longer are leaving on the table from if you were just to invest in other ways. It's pretty incredible. But yeah, I was curious about that. So basically for you, Isaac, you're in this stage of your life where you're like, I need a couple more years of brokerage experience under my belt, whether that is to save up some more money to be able to invest, or just would it be that, or would it be to get the experience, or both? Was that a clear question? Did all my words come out? Both. Okay.
Yeah.
I have a wife and 4 kids, so definitely need to make sure that we have all the expenses covered, etc., and then be able to, get a little breathing room, and then we might be able to look at some investments for ourselves as well. Definitely. But also getting more experience on the brokerage side, understanding markets. And I think the other important thing, and another thing that I learned with that first deal with these buyers that we helped this year, is understanding what is the core motive of the investor, and working that out for myself as well. What I mean by that is not only asset type, but what metric does that investor want to hone in on the most when they're looking at purchasing a property? And for our guys, it was cash on cash. So I mentioned earlier, I talk about this, why they paid all cash and didn't take on any debt. So their metric was cash on cash return. They're not looking at the IRR. They're looking at buying properties and holding them for a long time. And they wanted a minimum 5% cash on cash return. So Renee, the first thing she had me do was say, okay, we've got the information. We've got the P&L, the rent roll. We've got the expense schedule. We understand the metrics of the property. You were a lender. You can go and work out if they were to get a loan at 50% LTV, 50% loan to value, what would that cash on cash return look like? And interest rates at the time were like 7%, not too dissimilar to where they are today. I think they're a little lower than they were maybe 6 months ago when we were looking at this. And so we ran the cash on cash and it was like 2.9. Even at 50% loan to value, cash on cash return was only 2.9. And so they actually decided, okay, instead of buying more units and leveraging at 50%, we're just going to pay all cash, wait for the rates to come down, and then reassess, reevaluate at that point when rates hopefully eventually do at least normalize. I don't think we can go to 3% again. I think we'd have chaos in the streets all over again if that happened too quickly. Yep. But we'll reassess and then see if we want to take out some debt at that point and go buy more properties.
Cool.
Yeah, I was going to ask you about that, why all cash, but that makes a lot of sense because think through this. Do you remember the definition of cash on cash?
Yeah, I do. It's the amount of money that you're making averaged out over the life of the, what am I thinking of?
That's more internal rate of return.
Oh yeah, that's IRR.
Cash on cash, the numerator of the ratio is what did I get out of the deal this year?
Yeah, but that's like per year averaged out over the life, right? Okay.
It's an annual thing. So when they look at, okay, I'm going to buy it. I've got $1 million in it. If they want 5% cash on cash, they want to get at least 50 grand out of it.
Yeah.
Is that right? Is that the right number? Be 50 grand over $1 million. Now, if they put debt on it, you take the annual debt service out of the income, out of the numerator of that equation, essentially. And then you take the amount of debt you have out of the denominator. So you have less money in the deal, but you're paying debt service on it. And so you're getting less on top. So their equation was, and we want 5% on our money, cash on cash every year. So every year I want to make 5% on the actual dollars I have in the deal.
Yeah.
And the only way they could do that in today's lending environment was to pay all cash.
Gotcha.
And I was wondering, Isaac, if it was because of something like that, or if they were wanting, just some other, like you could just be risk averse because every dollar of debt you have increases the risk profile of the deal. You could, at first I was thinking maybe they were just going to, cost seg the heck out of it and get a lot of bonus depreciation, but you can do that on the bank's money. That actually works better if you have debt on the deal because you're you're cost segging and bonus depreciating the bank's dollars right along with your own, and you get to keep all that depreciation, I should say. So that actually works better when you have debt on the deal. But yeah, that's interesting. But it really speaks to the point of the broker understanding the core motivation of their client. Right. Like, what are they actually trying to accomplish?
Yeah.
So most of the people we work with, they're focused on IRR. And if they're not, I like IRR, and I tend to sway them that way. But if they're if they're stuck on cap rates, that's a problem. But I'm going to help them. I'm going to basically give them the information they want and the way they want it. But you got to understand what that is first. And that's really smart that you guys are doing that, Isaac. Yeah,
that was CCIM classes in action right there.
Yeah. Well, I tell you what, I've learned a lot, a lot of new things in this episode.
Well, yeah.
Yeah.
Yeah. I mean, have we had a lender on here before?
I don't think so.
Oh, you know who else is a lender turned great broker, Isaac? Top producer, Todd Humphreys.
I don't think anyone.
Top producer, Todd Humphreys.
Yeah, he was a lender, and it's made him really effective at his job.
Yeah, that's right.
That's one of the reasons he's really good at commercial real estate, but yeah.
That's right. Cool. Well, we're getting there. Should we do a
Yeah, we should.
Yeah? Why don't you ask me?
Isaac, you want to do pop quiz?
Yeah, let's do it.
Yeah!
Ba-da-ba-da-ba-da-ba-da.
Do-do-do-do-ba-da.
He just sang our song.
Ba-do-ba-do-ba-do-ba-da.
That's awesome. All right, Isaac, it sounds like you know how this works, but this is how it works. We're going to ask Timmy 5 questions. It can be based on the content that we've shared today or anything else that you want. As the guest, you get to ask the first question, the third question, and the fifth question. I'll do questions 2 and 4, and we'll see how Timmy does. So, Isaac, question 1.
Timmy, what is a T12 statement?
It stands for trailing 12 months. And this is a statement looking back at the last 12 months, essentially, so you can see all the expenses and net income that the property has had.
Yeah, revenues and expenses.
Revenues and expenses.
And it can also be referred to as, or like a T12 is a type of what?
Is this just a follow-up? Yeah,
No.
a P&L.
P&L.
A P&L, a profit and loss statement.
Good.
Yes.
Good. All right, nicely done. Nicely done. All right, question 2. I don't think we talked about this or have ever talked about this.
Okay.
But I'm going to ask you anyway because it's a good follow-on, and we can get Isaac's answer on the record.
Okay,
when
great.
He corrects you.
Great.
What is a balance sheet, and how is it different than a P&L?
Like in the context of a broker?
In the context of accounting for a property.
Yeah. What's a balance sheet for the property? It's, would that be you are...
All right, hold on. Before you just fish for it.
Yeah, okay.
Isaac mentioned balance sheet briefly.
Yeah.
In the context
of the
lenders and liquidity.
Right. So, and that's what I was thinking too, because the balance sheet came from, all right, I'm a commercial real estate lender. I have got loans out for 4%.
Let me help you. If you're a bank, what are loans to you?
It's you're getting interest it's the product.
It's their assets.
The assets, that's right.
So
you got assets on the balance sheet, which show you what's in your portfolio, and then you also have the liquidity of the amount of dollars that you can also lend out, and you want that quite balanced depending on the interest rates.
That's really close. So Isaac, you want to clean him up just a little bit?
Yeah. So your balance sheet is you got your assets on one side, and then you have your liabilities or equity on the other side, or liabilities plus equity. Because what you're looking at is, how did we buy the asset? Did we use all cash, in which case we don't have any liabilities on this side? We just used equity. We used our own cash. Or did we take out a loan plus use some of our cash, so we've got a liability and equity on the other side of the balance sheet? And those two numbers have to
balance.
Yeah, there you go.
Yeah, okay,
Very
cool.
nice.
Yeah.
The only other thing I want to mention about the difference in a P&L and a balance sheet is a P&L shows you a period of time. Okay, so you're looking back, you can see a P&L for a month. You can see a P&L for a quarter, over a year, over a number of years. I mean, it really doesn't matter, but you're looking back over a span of time. A balance sheet is a picture of that moment.
Yeah, gotcha. Yep. Cool. Cool. It was so funny in the way you said, why don't you clean it up? Why don't you clean Timmy up? I felt like a baby with a dirty diaper.
That's not what I meant.
He really had to wipe up my assets. Yeah.
Yeah, he's wiping your assets. Yeah. Oh, my gosh. All right, Isaac, question 3.
We may or may not keep this one in, but you just said a dirty diaper. What do the British call a diaper?
A nappy.
Bingo.
Woo woo. Yeah, a nappy.
What do the Irish call it?
A nappy. Yeah. They call it a nappy. That's how I know.
All right.
That's how I know.
I didn't know
Dirty
that.
nappy.
I didn't know that.
Dirty nappy.
We're providing all kinds of value to the listeners today.
That's right. Poo.
Hey, look, man, if you're going to bring some flavor, bring some flavor.
Bring some flavor.
You know?
Yeah.
Okay. So, all right, question 4. You are basically 3 for 3.
Yeah.
We kind of had to help you with question 2, but that's
was
good.
yeah.
3 for 3, doing well. Okay. Question 4. What are some things name 1 or 2 things? Just name one thing that you might find on a balance or on a P&L that you could have to add back in
Sure.
to come up with the net operating income of the property.
Sure. Well, with the example you showed me, it'd be like the roofing repair. But more specifically, or maybe more generally, it's really any expense that's owner specific. That's specific to the owner. So that could be a loan, the interest on a loan that would change with the other owner.
Yes.
Yeah.
Great answer. Great answer.
Yeah.
All right. All right, Isaac, you're up. Question 5.
In the current commercial real estate market environment, what value could a broker bring to their client who needs a loan to buy a property?
Great
that
question.
client may not know or have on their own.
Great question. The value that you're bringing is your relationship, the amount of relationships you have with different lenders and understanding what their balance sheets look like, pretty much. Where are they lending? Where are they sitting?
That is a fantastic answer. Yeah, because I've done that. I've started looking up banks' balance sheets to see, do I think they're even going to want to quote this or not? Are they worth the phone call? Mm-hmm. That's a great answer.
That is a great answer. And the only thing I will add, since we were just at MassimoCon and we got to listen to Beth Azor speak.
Yes.
And one of the things that Beth always preaches is don't say no for the prospect. Like when you're going to reach out for a prospect and you have that conversation with yourself in your head and you're like, nah, they're not going to be interested in this. Like, don't say no for the prospect. Now, it's great to understand the balance sheet of a lender in this context, but you may not want to say no for them, right? It may just give you a lot of context and understanding when you make the call, but I think the more our listeners don't say no for people in their minds, but actually make the call, have the conversation, reach out, let them say no. Yeah. Right? You're at least going to learn something, and that's valuable.
And that's such a good lesson for everybody all the time. I think just too many people say no for the other person all the time.
Yeah, I do this with my wife, Autumn, all the time. I will project the conversation, and based on how that conversation ends in my head, I'll decide whether I'm going to have it or not. I love you, baby. I love you.
Good self-awareness.
But yeah, sometimes you hold things back, and you decide something for your spouse or your partners or the people you work with, and you project wrong. You make a huge mistake.
Right. Great advice. Well, this has been fantastic. Isaac, where can people find you if they're looking for you? Where can they find you?
What do most people say at this point? Basically, LinkedIn, I guess.
LinkedIn.
I could give out my phone number if that.
If you want people calling you, give out your phone number. If you want people reaching out to you via email, do it. Like, what market do you serve? Like, if you're listening in the Pacific Northwest, like, do you want to talk to somebody in Utah? Like, give us a feel for the geography you work in and how people can reach out to you if they want you to represent them.
Yeah, so I am a licensed Oregon broker, so I can list properties in the state of Oregon. I would say my main focus is multifamily. That's what I really did well as a lender, and so that's translated very well into the brokerage world. We also look at retail and industrial, are the main things we do in my brokerage shop. My principal broker is an SIOR, so started to learn much more on the industrial side as well. So yeah, if you're in the Pacific Northwest, Oregon, Washington, Idaho, Utah, I've even done, when I was a lender, I did a deal in Winnemucca, Nevada.
Oh,
Winnemucca.
So,
all right.
If you're in the Pacific Northwest, I would love to connect with you. And my phone number is area code 541-525-6907. My email address is isaac@cwwalker.net. That's Isaac spelled ISAAC @cwwalker.net. which is WALKER.net.
Great. Amazing. Amazing.
You can also just reach out on LinkedIn.
Yep. Excellent. Isaac, thank you so much. Everybody else.
Are you guys going to do...
Yeah, go ahead.
Are you guys going to do an episode on Massimo Con? I'd love to hear what that experience was like.
We will.
You know, we probably won't do an episode that's just about Massimo Con, but we're going to have a number of episodes coming up with people we met at Massimo Con. So it will definitely be a part of the conversation.
Yeah.
But we're going to have Beth Azor on in the coming weeks, Sam McVeigh, who
Australian real estate broker. Yeah.
Awesome. He blew me away with what he was sharing. I'm really excited about talking to him. We're going to have an episode coming up with Lonnie Hendry and Kevin Bassett, which is going to be a more of a
forecast
show. Like, how do we expect the tax situation to change with the new administration? What do we think the real estate outlook going into 2025 is? So a lot of it's going to have to do with a lot of tangential stuff with Massimo Con.
But yeah, we've got a lot of exciting things coming up. Anybody that has not subscribed to our newsletter yet, it comes out every single Thursday. It's completely free. Subscribe.ugbarron.com. Sign up for that. You will get curated articles on negotiation, business, a lot of the things that my brother consumes that makes him so amazing. And I just admire him so much. If you want that kind of admiration from me, you probably want to read those articles as well, and they'll come free to you in the inbox every Thursday. We'll also have the latest episode of Commercially Speaking. We are on all social media platforms for the most part at Commercially Speaking. If you want to follow us on X, that's COM, Speak Pod. Speak Pod. And
look, if you've gotten any value out of any of these episodes, the best way to return the favor is to actually pay it forward. Share these episodes with somebody that you think they could benefit. That's the biggest love you can send our way. So we love to hear from you, but if you share the episodes, that does wonders for just getting the word out.
It really does. It really does. And if you are somebody who watches on YouTube, of course, subscribe, ding that little bell so you don't ever miss when we post. I know there's a lot of people that listen on Apple. If you've not left a review yet, we would love it if you took the time to figure out how to do that, which is basically you go to our channel, scroll down past a few episodes, and you'll see all the ratings and reviews, and you can leave a review there. We shout out every review we got. Do we got a new one to shout out?
We do.
All right, sweet.
We do. So, Tony Rochelle. What he says, this isn't another dry market update or business talk like some spewing verbal ticker tape of your financial advisor's hold line. Instead, you get useful real estate insight cultivated in inquiry, warmed by humor, sprouting from wisdom, and reaching to the heights of client stewardship. Thanks for making me laugh.
That is a killer review.
What an awesome review. Tony, thank you so much for taking the time to do that. We really, really appreciate it. And
yeah, and if you want to get shouted out like that, we will. We'll do it. Just write us a little review. We'll do that. We'll throw out some comments as well. Shout out to everybody that we met at Massimo Con. That was amazing.
Oh, yeah.
It was amazing to hear the response, to hear from you all, to hear the feedback. It was so much fun to do something live together up in front of that audience. I posted a video on our day one at Massimo Con where Bo and I got to speak. And so you can see that on the social platforms right now, little 1-minute video. But big shout out to everybody that we met. There's too many people to name right now, but we might, maybe on the next episode, I'll create a little list of people that we met there that we love. But this has been great. Thank you all so much for watching. Isaac, Grant, this has been amazing.
Great episode. Thank you so much for your time and for rolling with our schedule. And it was great.
Privilege. Absolute privilege.
All right. We'll see you all next Monday.
All right.
Yeah.
Love you, brother.
Yeah.
Love you, man.
Bye, Alice.
Bye, Alice.
Bye.
Yoo-hoo. Isaac, you want to say bye, Alice?
Bye, Alice. I should have said toodaloo, Alice.
Toodaloo.
Tally ho, Alice.
Oh, yeah. Toodaloo. Hello, governor.
Cheerio, Gav.
Cheerio, Gov. Like going on a little holiday with Hitler. That's
Tally-o, governor.
Yeah, tally-o, governor.
Okay, I'm shutting this down.
It was nice to have a ADHD Brit on here.
I appreciate that. I honestly was nervous. I mean, you've had You've had Bob Knackle, you've had Rod Santomassimo, you've had your dad. I mean, you've had some big hitters.
5 years from now, no, 3 years from now, we're going to have somebody on here and they're going to go, man, I was kind of nervous. You've had Isaac Grant on your show.
That's
And we're
right.
like, I know.
That's right.
I
That's
know.
right.
We had him before he blew up.